Well, good afternoon, everyone, and thank you for joining us today as we have Dr. Wes Gray with Alpha Architect going to deliver today's presentation on why value investing is simple but not easy. But before I actually do get underway with Dr. Gray, notice I am going to pass the ball over to my colleague, Emmett Peppers. Emmett has worked with Dr. Gray and is going to be introducing him here this afternoon. So thanks for joining us, Emmett.
Thanks, Cynthia. Hi, this is Emmett Peppers. I'm an institutional sales rep with Interactive Brokers. I've known Dr. Wes Gray for a few years that he's been a customer of Interactive Brokers. He's a finance professor at Drexel University and founded Alpha Architect, LLC, which is an SEC-registered advisor. His views are closely aligned with ours in that he strives for the end client to get the most cost-effective solution for their investment capital. And below is my email address if you have any questions about starting a relationship with us. But I'll let Wes take over from here, as I'm also very interested to see his presentation today.
All right, thanks for the introduction, both to Emmett and to Cynthia. The discussion for today is going to be about why value investing is simple but not easy. And I reference value investing merely because it's an example here, but really what this mini lecture is going to be about is understanding behavioral finance, what it is and what it isn't. So first off, disclosures. I'm not going to talk a lot about what we do, obviously for compliance reasons. There is one small back test included in the results. And as we know, all back tests, you never seen one you didn't like. So take them with a grain of salt. Past performance on those things don't represent the future and all those typical disclosures. So what I'd like to start with is what we call this framework of the sustainable alpha pyramid. And where this is derived from is we spend a lot of time working as an asset manager, but we also spend a lot of time as a due diligence agent on behalf of some large family offices. And one of the things that many investors focus on when they're trying to assess a strategy or a manager is they tend to focus on past results exclusively. The problem is that that's not really a great way to go about things, because there's a lot of research to suggest that by simply looking at past results, you're not going to be able to predict future returns. So the natural question is, well, how would we actually predict future returns, which is what we care about as an investor or someone who's devising new strategies. And it all boils down to this sustainable alpha pyramid, where you'll notice at the bottom, or the foundation for the pyramid, is this concept of robust idea generation, or what a lot of people refer to as process. So we need to understand, what is this strategy's process, how has it worked in the past, and do we believe it'll continue to work in the future? And the reason this is so important is there's a lot of times where someone can have a poor process but really good past results just by random luck. Security prices are highly volatile, so we can have someone engaging in, a dart throwing competition, and they may just end up very lucky, whereas someone who might have a nice process has gone through hard times might actually have poor past results. However, going in the future, it's likely that the dart throwing process is probably not going to generate, good future returns on average, whereas the individual or strategy that has a good process in place has a better than average chance of actually generating good future results, even though in the past they may have been, less than ideal. Now, robust idea generation is not the only thing. On top of that, we got to develop good ideas, but then we also need to have a risk management procedure in place, because even if we come up with, say, one good idea and we invest all our capital into that idea, there is a chance that any investment could go bad, and you can't compound $0. So we need good ideas, we need sensible risk management processes in place that manage those good ideas, and then not only that, we need operations. So we have good ideas, we have good risk management, but when we send the trade from the PM to the trader, we tell the trader to buy Microsoft, they turn around and sell Microsoft. That kind of defeats the whole purpose of good ideas and risk management. And one of the areas, and why just as a small shout out to Interactive Brokers, is the more we can leverage technology and automation and eliminate human elements, the tighter we can make our operations to ensure that when we want to execute on our good ideas and our good risk management, it actually happens. Now, only once we've identified a good idea generation process, solid risk management procedures, the operational integrity to make sure we can actually execute on our ideas, then past results might help us understand and predict future results. But main point is we don't want to focus on past results because that's not what is driving future returns. It's really all about this foundation of robust idea generation. So we're going to now talk about, well, how does one come up with a framework for developing ideas that we think are robust over time? So first, some background. So I guess another lifetime ago, I was a PhD student at the University of Chicago, and I was working on my dissertation where, you got to figure out what are we going to write about. So I've always been enamored with value investing, and I've been following this organization called value-investorsclub.com, which, for those of you who are unfamiliar, is an organization set up by Joel Greenblatt, where he set up basically a chat board for sophisticated value investors who wanted to share in-depth, detailed analyses on a variety of investment pitches. So what I ended up doing is I read all 4,000 of those ideas, and I said, you know what, these guys seem to be doing the sort of work that should generate alpha. Let's actually see if that's true. So I wrote up my initial abstract, and I made this conclusion at the very end. I said, value investors have stock picking skills. And at the time, my advisor, who's now obviously a lot more famous than when I knew him, Eugene Fama, who's obviously a Nobel Prize winner and kind of the founder of the efficient market hypothesis, he basically told me, your conclusion has to be false. So my dissertation advisor, who had read just my abstract and basically threw my 2 years of work under the bus. And I was like, well, that's not very inspiring. But it turned out when I asked him about it, it was really a semantic issue. So his beef with my conclusion is that I said that value investors have stock picking skills, where really what I meant was the segment or the sample of value investors that I had analyzed seemed to have stock picking skills. And the reason Professor Fama brought that point up is he has this idea, which makes sense, is that on net, active management does have to be a zero-sum game at some level, where if someone's winning, someone has to be losing. So he just had beef with my broad conclusion that implied all value investors have stock picking skills, where I really meant just my specific sample. Main point was this exercise convinced me personally that markets are not perfectly efficient. They're extraordinarily efficient, and it's very, very challenging to beat the market, but there does seem to be some evidence that they're not perfect. So fast forward a few more years, another experience I had in my life is I was actually a captain in the United States Marine Corps. So I served from 2004 to 2008 as a ground intelligence officer, and one of my experiences was I got to hang out and in bed as a military training advisor with the Iraqi Army. So here I am in a little village near Haditha, which is in Al Anbar province, where all our ISIS buddies are hanging out right now. And I'm on the left here, and I'm with two of my Iraqi friends. And right now I'm labeled myself as the rational people, which is honestly kind of rare, so I got lucky here. And then we have another label over here for irrational people. So let me explain what's going on. Well, you'll notice it's 120 degrees here. We're in a hot area where there's always getting mortars everywhere and you're getting in gunfights. And we are wearing our Kevlars. Well, why do you wear a Kevlar? Well, you wear a Kevlar because if a mortar hits this hut in the background here and you get a fragment of cement going at your head, if you don't wear your Kevlar, you're going to die. So we're going to wear Kevlars. The other thing we're going to do is we're going to carry extra ammunition. So if you get in a gunfight and you don't have ammunition, you obviously have problems. and so we're going to carry extra ammunition. And then the other thing is it's 125 degrees outside, so we want to make sure that we're carrying a source of water, which is usually in the form of a Camelback, because if you don't hydrate, you're more likely to die from heat stroke than you are from, getting into some war battle. So we're doing all these rational things that seem to make sense. However, if we look at our exhibit over here on the right, he has no Kevlar. Well, why would you wear a Kevlar when it's 125 degrees outside and it's hotter than Hades? And our friend says, we're not going to wear it. He also says, well, why would I want to carry ammo? 30-round mags of 7.62 AK-47 is not exactly light, so I'm not going to carry it. And then water, who wants to carry water? That's also extremely heavy. Why am I going to do that? What this highlights is that whenever we are engaged in emotional, stressful situations, we sometimes do things that are not always rational. And this is not something that is only for, our Iraqi friend here. This applies to everyone. So, logical, simple conclusion might be, well, we've identified that markets are not perfectly efficient. And we also know that there's a lot of people out there that are just not that rational. So lo and behold, that's going to mean that we're going to all be super rich, because we're just going to go exploit anomalies, figure out where there's people making bad ideas, and just, go home to the bank and all become Warren Buffett. Well, unfortunately, it doesn't work out like that. But it does lead us to this discussion of behavioral finance and what it is and what it isn't. And before we start this discussion, it's important to kind of frame how academics and people that actually study behavioral finance think about it. So a lot of us always hear about the efficient market hypothesis, where the underlying assumption there is that prices always reflect all publicly available information. And the conclusion is, which is a correct conclusion, is if prices are right and they always reflect all fundamental information out in the marketplace, there will be no free lunch. And the classic example is the $20 bill lying on the pavement. This will never happen in an efficient market because it's so easy for anyone to simply pick up that $20 bill. So when we go to empirically investigate the pavement, we're, all intents and purposes, never going to see $20 bills lying around. And one of the logical conclusions of a lot of this thought process is when efficient market hypothesis proponents read the literature on the performance of actively managed mutual funds, they say, wow, look it, all this research shows that these active managers can't beat the market, therefore markets are efficient. The problem is they've made a logical assumption that just isn't true. Because it is not the case that just because there doesn't appear to be a free lunch and we don't see loads of evidence for active managers outperforming the market, that does not imply prices are right. And I have this example here where I have this picture of a grizzly bear with a $20 bill in his mouth, right? So clearly prices are not right. We shouldn't see $20 bills just lying around. But it's not like in the case up here above where the $20 bill is just laying on the pavement, that's easy to pick up. But it's not the case that in the marketplace, picking up these quote-unquote easy $20 bills is costless. We might have to pull it out of the jaws of a grizzly bear, right? So just because we don't see a lot of evidence that people are like becoming billionaires by exploiting mispricing does not mean that the prices are right, because it's sometimes expensive to arbitrage and take advantage of anomalies in the marketplace. And really, when you boil down what behavioral finance actually is, it's broken down into two components. One, understanding behavior, what drives the psychology of investors to make bad decisions where they will buy or sell a security different from its fundamental price. But that's not enough. We need to also understand the market frictions that are at play in the marketplace, because only when we see behavioral issues and inability for market participants to exploit said behavioral issues, do we actually identify systematic mispricing and potential opportunity? And one way to frame this is behavioral finance is really about understanding who are the worst poker players at the table, but also understanding who are the best poker players at the table and why aren't the best poker players taking advantage of the worst poker players. And when we find that situation where we see who the worst player is, we see who the best player is, but the best player is not exploiting said worst player, this is where behavioral finance starts to become interesting, because now we're seeing true mispricing, and we can now try to explain it with these two elements or these two tools. Now, what are some of these tools when we break them out? Well, when we're out there trying to find these opportunities or the so-called sustainable alpha, it's really a two-step process. First, we've got to understand psychology, right? So there's all these different biases that, you know, traders, investors, and just human beings as a whole actually succumb to. And it's just by nature of being born, you know, you're going to have all these things. So we want to understand this because we want to understand how, why, and where our decision-making processes are going to be faulty. But that's not enough if we're going to try to make money taking advantage of this stuff. We need to also be very savvy on the marketplace and understand what the best poker players in the world are out there doing. And, you know, we can break that down to these limits of arbitrage, and there's frictional limits of arbitrage. So sometimes you find an idiot trading in the marketplace, but maybe there's excessive trading costs to exploit that idiot, so we can't do it. Or maybe the leverage costs are too expensive. Or maybe on the institutional side, because there's a lot of principal agent problems associated with delegated asset management, you know, if a strategy has huge tracking error or deviation from a standardized benchmark, and, you know, we could basically lose our job if we engage in exploiting this idiot in the short run, you know, maybe we're not going to do that. So in the end, real alpha that's going to be around for probably a long time is going to be driven by the combination of both bias and an understanding of the limited competition that's out there. Because if there's only bias and it's easy to exploit, it's going to be gone very quickly, right? If there is no bias and there's limited competition, well, who cares? Because if no one's ever buying or selling away from deviated fundamentals, you know, it doesn't matter that there's limited competition because there's not opportunity. So again, to reemphasize, you need both of these elements. Now, moving into an applied example, we talked a lot about, you know, the theory of behavioral finance and this behavior component and then understanding the friction component. You know, let's do an applied example. In particular, let's look at value investing. But before I'm going to continue here, let me just review some of these questions in case someone's sitting somewhere here, in case somebody sent a question here. All right, so there's a question about our ETFs and funds. Are we invested? Yes, but we'll move that later on because I want to try to avoid talking about our stuff here. So value investing. So for people that aren't familiar, there's this so-called value anomaly. And what is the value anomaly? Well, historically, academic economists have basically said, let's sort securities based on some valuation metric, you know, price to earnings or price to book or whatever it happens to be. And what they found is that when you simply sort securities on one of these valuation metrics by simply buying the cheapest stocks, those tend to outperform the most expensive stocks anywhere from, you know, a couple hundred basis points to upwards of 1,000 basis points. So 2 to 10% excess return, depending on how you cut it, whether you're looking at small caps, large caps, or what have you. And there's two competing explanations for this. One is, and this goes back to the efficient market proponents, well, the reason these cheap stocks outperform the expensive stocks by so much is because they're simply riskier, right? There's something inherent about the cheapest stocks out there. You know, maybe they're in a business that's going to die, or they got too much debt, or what have you. And so logically, they should earn much higher expected returns than these really expensive securities. That's kind of the risk-based hypothesis, and that's obviously promoted by, the most famous are probably Ken French and Eugene Fama, and that's their pitch. Now, an alternative pitch, which I personally find more compelling, not just because I like it, but because I think the evidence actually supports this, is one of the behavioral bias explanation for why value investing works. And this was first explored formally by Lekonchak, Cipher, and Vishny in a Journal of Finance paper they published in 1994. If you send me an email, I'm happy to send you the paper. And they basically say, listen, we think that the value anomaly is not risk-based, it is behavioral-based, and it's all because investors systematically have this thing called representative bias, where they extrapolate the good news associated with these expensive firms too far out into the future, and they extrapolate the bad news associated with value firms too far out into the future. And so how do they go about examining this? Well, what they do is they sort all securities in the universe based on book to market, just one of these valuation metrics that academics like to use. And they say, okay, we have our cheapest or most expensive stocks right here, and then we have our cheapest or our value stocks here on the right. Now, on the y-axis, we have the past 5 years earning growth rates. And what do you notice? Well, you notice a compelling profile here, where the most expensive securities tend to have the most encouraging past 5-year earning growth rates. And so the market is logically, or perhaps illogically concluding that, well, look it, these guys have earned, 20% plus over the past 5 years, so they're going to continue to do that for the foreseeable future. So of course we're going to pay a really expensive price for these securities because they're growing so fast. Now, on the opposite side of the spectrum, we have these value securities. You'll notice that cheap junk value securities out there have been doing poorly, right? That's why the market is pricing them cheap. Over the past 5 years, on average, they've actually had negative earnings growth. So the market says, well, listen, negative earnings growth over the past 5 years, God, that's terrible. That's going to continue in the future. Why in the heck would we ever pay a lot of money for those sort of securities? And that's fine. That's what's reflected in prices. Now, the question is do these expectations about future growth actually come to realization? Or is there some sort of systematic mean reversion in fundamentals that the market just fails to appreciate? Well, that's actually what really happens. So expensive securities are priced to have really, really good future growth rates. And unfortunately, on average, they tend to mean revert and they never are as good as expected. So the reason expensive securities don't perform that well on average is the market is continually surprised when Facebook comes out and apparently they're not growing at 50% anymore, now they're only growing at 10% or whatever it happens to be. Likewise, when we look over here at the cheap securities, we got to ask, well, why do these things continue to always, on average, over long time periods outperform? Well, these securities are priced in the bargain basement as if they're basically going to die anyways. But what happens is these firms systematically, on average, their fundamentals mean revert. And this expectation change shocks the market, and the market's like, oh, wow, these are actually worth more than we thought. And then that is why these cheap securities, on average, tend to have better performance over time. So that's kind of the real baseline, simple behavioral explanation for why value investing works and why it's not the reason there's the spread. It's not because they're risky, it's because there's this psychology problem. So we've identified what we think is this psychology issue with representative bias. where investors systematically extrapolate good news too far out into the future, and they systematically extrapolate bad news too far out to the future. But that's not enough, right? Because a lot of people know this. You know, Ben Graham talked about value investing and how it makes, 500-600 basis points over the market. And you can backtest his exact same strategy over the last 50 years out of sample. And guess what? It also makes 500 to 600 basis points over the market. So the logical question is, we've identified now who the bad poker players in the room are, all these people that suffer from representative bias. But then we got to ask the question, well, where are all the smart poker players in the room, right? It's not like there's that many people that, don't know that value investing works. We need to understand why in the heck are the smart money guys with the trillions of dollars of capital, why aren't they out there arbitraging this? Well, in the context of value investing, the problem with doing high conviction value investing is it's very easy to lose your job because these strategies have high tracking error with respect to standardized benchmarks, where tracking error is basically defined as the volatility of your returns relative to some standardized benchmark, right? So a perfect example is just a generic value stock screen, which has beaten the market by, let's say, 300 or 400 basis points over the last 50, 60 years. But from 94 to 99, it goes on this 6-year run of absolute skull-crushing relative performance. And the market's out there saying, hey, Warren Buffett's lost his magic touch. Who wants to be a value investor? That's for idiots. We all need to be growth investors, etc. Now, the problem is if I'm an individual and I control my own capital and I just care about long-term, geometric compounding my wealth, I may look past this because I'm like, hey, I know this stuff works. I believe in the process. And if there's a 6-year run of lean years, so be it. I'm stuck. I'm going to continue to do it. The problem is most of the capital is not controlled by individuals. It's controlled by delegated asset managers who look at stats on value investing and they're like, wow, great strategy. Here's the problem. If I'm running a fund that underperforms the S&P 500 for 6 years, I will not have any assets. And if I don't have any assets, I don't have any asset management fees. This is a bad idea. So all of the largest firms in the world are not stupid. They're good business people. And they think, you know what, it's much safer to just be good at marketing, closet index, stay tight on the S&P 500, and leave this crazy, highly active value investing stuff for someone else, the family office guy or the individual or whoever can deal with this sort of, 5-6 year long, debauchery. But this is great, right? Because now we understand why, at least potentially, through the lens of behavioral finance, why value investing might be something that is a sustainable anomaly, because we identified this psychology problem that's pretty systematic, and as long as you believe humans aren't going to, get rational overnight, it's probably going to exist for a long time. But then we've also understood what are the best poker players in the room doing. Well, they're really, really worried about tracking error, and it just so happens that these high conviction value strategies have enormous tracking error and have great potential to get managers fired. And that's also good because now we know that there's going to be limited competition. So when we identify poor psychology and limited competition, we identify what we think is a sustainable opportunity over time. However, it's going to require you to be different than the people that suffer from this tracking error and job security problems, which is just either you got to be a unique investor with true long 5-10-year horizons, or you've got to be a delegated asset manager who can educate your client base to understand that, sure, maybe you've been outperforming for the past 2 years, but stand by because we will underperform for perhaps a multi-year time. But you've got to be disciplined enough to believe in this process. Otherwise, you might as well buy Vanguard S&P 500 fund, because if you're whipsawing in and out of a high conviction value investment strategy, even though over time the strategy will probably work, on a dollar-weighted invested basis, the client is probably going to actually lose money and underperform relative to, a standardized benchmark. So doing behavioral finance and doing value in particular it's a great example of, again, value investing is simple, but it is definitely not easy. So that's what we do. Just as a small pitch, not about our products, but just if you want to learn more about this in depth, I have a book I wrote alongside Toby Carlisle called Quantitative Value, which it kind of explores a lot of these concepts in greater depth. So anyways, that's the basics. Let me go through some questions now that people have asked, and I'll try to answer these for you guys. So Mr. Hansen here says, value metrics, or is it the quality metrics we should be concentrating on? Well, so all the research that we've done, and when we think about value as through the lens of behavioral finance, it's really about price. Because quality, if you think about it, what is the behavioral psychology behind why quality would be mispriced? Right? I can't think of one. Everyone knows that Google is a great company. Everyone knows that Coca-Cola is a great company. So quality as a standalone metric, it doesn't fit into this framework of behavioral finance, whereas price does, because we can identify that pricing is a way to basically proxy for this representative bias. Now, that doesn't mean that we should throw quality out the window. It's just that quality is something that we don't want to think about at the outset. We want to, first off, identify where the psychology is worst and where the competition is limited. That is in the cheapest bucket of securities. Now, within that cheap bucket of securities, there is evidence, and there's also behavioral reasons why we won't discuss now, but why using quality metrics to separate basically the winners from the losers within the cheapest securities can add value at the margin. Now, but you do see a lot of people in the marketplace offering products that leverage quality in the same level as they leverage value. Well, again, let's think about why that might be. Well, it turns out that quality has way less tracking error than value does. So the large asset managers, if we go back to think about their incentives in the marketplace, their incentives are to outperform, but not really. Their real incentive is to not lose assets, and one way you don't lose assets is you kind of run around a closet index on S&P 500, never beat it too much, never lose to it too much, but have good marketing and just don't lose the assets. So it's too dangerous to run a highly active value strategy and be able to accomplish that mission. It's much easier to maybe try to build a little edge with value, but if we pepper in a lot more quality, we know that on average our tracking error is going to be minimized, so it's better to dilute the strategy by focusing on quality on the same pedestal as value than it is to do what we consider kind of the best risk-adjusted return approach if you have long horizon, which is to focus on value first, then use quality to try to separate amongst those cheapest securities those that are good and bad. So hopefully that's long-winded, but hopefully that addresses that question. So another question is, why the reverse does not happen? Why do growth managers not lose their jobs when they underperform value stocks? So that's a great question. That goes, again, to tracking error and relative performance. Growth stocks in general tend to have a beta that approximates 1 on average, and they tend to have less tracking error. And there's also, for whatever reason, a mandate out there to invest in quote-unquote growth. Why that mandate is out there, I have no idea, because all the evidence in the world suggests that the minute you buy expensive securities, you're shooting yourself in the foot. And the argument is, well, we want to own growth because it's uncorrelated or it diversifies this value exposure, which we all know has huge tracking error, and that's going to all get us fired. And that's a fine argument, but then I got to raise the question, well, why are you focusing on growth which is simply looking at the expensive securities, and not momentum, which is a true anomaly phenomenon that is also grounded in behavior. We're not going to talk about that right now, but if people want to do growth, but the intent or the mission is really to diversify their value exposure, you don't want to do growth, because we know buying expensive securities is just a bad idea. What you probably want to focus more on is momentum, where momentum is not growth. It's somewhat correlated, but it's different. Growth, as typically defined, is expensive, so it's like P over E, where momentum is all about P, movement in price. But if the E is going up fast and the P is going up fast, you can still have high momentum, but may not necessarily be growth. So we think a smarter way of going about a growth exposure would be to do it through a basically momentum lens, not like buying expensive securities. Make sure it has high momentum. So next question here, and I'm not sure if I answered that question, but growth managers do lose their jobs, but they're not benchmarked against value stocks. They're usually benchmarked against SP 500 or some growth indice, and growth managers tend to flow with the S&P 500 better than value managers do. Another question is, how many equities do you hold in your portfolio? Do you have a market cap sector bias? So that's a great question. And again, what is your objective? If your objective is to exploit these sustainable anomalies, you've got to be wired a little bit differently. You got to be willing to take tracking error. You got to be highly active, and you've got to have 5, 10-year horizons. So how many equities do we hold in our portfolios? We hold concentrated portfolios, around 30 to 50 securities, and because we don't want to diversify. Well, what do I mean by diversification? Well, diversification is this phenomenon that is commonly engaged upon by large institutional asset managers, where they say, listen, value is very interesting, but we will all lose our jobs, and it doesn't make sense to build a massive business on a high conviction value strategy, because it may have limited capacity, $1 billion or $2 billion. We're going to make a smart beta version of it, or we're going to do what Rafi does, where we kind of like tilt towards value, but we still hold 500 securities. The problem is that's not exploiting the anomaly. It's kind of a half-ass exploitation of an anomaly, but really what those investment advisors or managers are doing is they're essentially creating a Vanguard S&P 500 exposure with a small tilt towards the anomaly. So you're effectively buying 95% Vanguard fund, 5% active management, and we think that's not how you want to go about it. If you want to build a real product that's going to truly try to exploit the edge, invest with conviction and just own up to the fact that you're going to underperform for perhaps years on end. Now, the next question is, do you have a market cap sector bias? Well, this is also interesting. So we do have, in our case, we have a market cap bias because you can't run a business on penny stocks or micro caps just because they have limitations on scale and how much capital you can put to work. So we obviously focus more on like mid, large, liquid securities. And we also don't have we totally have a sector bias. And people always ask us, well, like, man, you guys have like massive sector bets and you're shifting around and doing this and that. And we always say, listen, if you want to do sector neutrality, if you want to like change the portfolio structure so it looks more and more like the market, do you think you're going to exploit the anomaly, or do you think you're going to be more and more like the Vanguard S&P 500 fund? Well, of course, if you constrain yourself to invest in the same sector weights as implied by the S&P 500, in a time like 1999, you're going to invest in the cheapest tech stocks, where the cheapest tech stock is 50 times price to earnings. Is that value investing? Is that exploiting the value anomaly? No, right? So you're just diversifying the exposure and you're moving away from what the intent of the anomaly is. So again, we just own up to the fact that we're going to have huge bets on certain sectors that are just the cheapest sectors in the marketplace, because we know historically that is how the anomaly works. and that's just what we're going to do. So here we go. I've got another question here. I have a question since I come from the world of coin flipping. So yes, I'm biased. At what time do you buy your securities once you've identified the candidates? Do you apply some kind of price filter to your timing, or do you stick to your 12-month SMA? So this is an interesting question. We are, I guess, not unique. We're just are what we are. We are 100% automated. Every decision is made by a computer. So we put all the research and development on the front end, come up with what we think is a simple, effective model. But to avoid the whole human bias problem, we just remove that from the process. So buy, sell, all these rules are baked in the cake. And the issue with how do you assess when do you buy and sell, how do you assess rebalancing? Well, it all comes down to the trade-off between the benefits of higher frequent rebalance relative to the cost of more transaction fees and taxes. So one of the things that's particular to the value anomaly is there's certainly some benefit, even on an after-cost basis, but not after-tax basis, to have higher frequency rebalancing, where you go in, reassess the model, say, okay, let's say we go in monthly. Who are the cheapest stocks? And we rebalance that monthly versus doing that, say, annually. Now, the problem is if we reassess monthly, we're obviously going to engage in a lot more turnover, which means we're going to engage in a lot more transaction costs, which we can deal with at some level. But we can't deal with the tax problem, because if you're churning the portfolio, you're going to have a lot more short-term capital gains, which that marginal rate is almost twice the long-term capital gains. So there's a trade-off to be made here. And what we do from a tax-efficient perspective is for managed accounts, for taxable people, you obviously want to focus on that annual rebalance, where annual rebalancing is suboptimal if we operate in a vacuum relative to, say, quarterly or monthly rebalancing. But, on an after-tax basis, if we rebalance around the annual level, we can transition from short-term rates to long-term rates, and then throughout that year, we can also systematically harvest losers and do some other tax tricks. And that, again, it all boils down to, if we operate in a vacuum, higher frequency is better, because we own a portfolio of cheap stocks. Let's say one stock goes up 1,000%. If we don't reassess that until a year from now, we're going to be holding basically a growth stock, which is on average going to dilute our performance. We'd much rather rebalance, kick that out, and put in the cheapest stock at that point in time. But of course, we have to weigh that sort of rebalancing frequency with the transaction costs and the taxes, which are very, very real things to consider, and that's just what you got to do. Now, if you're like an institution or an endowment, that's obviously cost are really your only concern, but even there, you got to think about the trade-off. So another question is growth. Is that equal easier herd following? I would say yes. So from a psychology standpoint, if you look at true value stocks, unfortunately, these are stocks that, everyone on the street hates typically. Everyone on CNBC says is stupid. Every newscast is about how the business is dead and how they're going to go bankrupt, etc. So just from like a human psychology standpoint, it's a lot easier to kind of just follow the herd and be a lemming. And there's tons of psychology research about that very point, where it's actually a lot less likely that you find people that are wired to kind of be mavericks or kind of contrarian by nature. So I definitely think that growth is just easier to handle from a psychology standpoint, whereas value is just, it's painful, right? Because you look at your portfolio, like for example, right now you might say, hey, we're 25% in oil stocks. That's not very fun. Like, oil is in the news every day. It's, one guy says it's going to go down to $10 a barrel. The other guy says, we're never going to use oil ever again. And could that be true? Sure. And that's what makes it scary. But, securities are insanely cheap in those asset classes. And, if we believe in this behavioral finance framework and we believe in value investing, on average, those securities are probably beaten down beyond what the true risk is that may or may not be embedded and associated with the fact that oil is extremely volatile right now. Okay, so when you talk about another question from Tim Brennan here. Oh, sorry, that was private. Sorry about that, Tim. My bad. The question was, when you think about quantitative value investing, how do you handle or do you consider market risk? For example, you may be invested in a concentrated portfolio of value stocks within the S&P 500, but if the S&P 500 undergoes a significant correction, most stocks tend to move with the current. So, outstanding question, and 100% correct that implicit in any long-only equity investment, whether it's value, growth, or anything in between, is you have a huge element of beta, right? Just general market exposure. And it's pretty painful when you tell a client, hey, the market's down 50%, we're only down 40% because we have these great value stocks. And sure, you quote-unquote added value, but you're still down 40%, and that sucks, right? So just because you're investing in value stocks doesn't mean you're eliminating what they call beta or market risk. Now, that's an entirely different conversation about how do you deal with that component. And that's, that now we're in the realm of kind of like market timing and financial engineering for making things long, short, and hedged and what have you. And, happy to have that discussion offline. We talk a lot about that on our website. But in general, and this may sound like heresy or maybe I'm a heretic to true value investors who tend to just do buy and hold forever, is I would recommend that you explore the research on trend following and momentum when it comes to market timing and trying to identify ways to figure out when do you want to actually hold and just own up to the market risk component versus when do you maybe want to say buy the value stocks but short the S&P 500 against them. So now you're kind of created a long short kind of market neutral hedged bet on value, but you're not kind of pissing in the wind when it comes to your overall market exposure. So another question from Bruno. He says, is it possible to filter out among the growth stocks those that will continue to grow and not mean revert, just like using a filter quality amongst value stocks? Great question. And actually one of my colleagues, Jack Vogel, who's also a PhD geek, his dissertation is actually all about that. And if you email me, I'm sure he'd be willing to share that with you. But it's definitely the case that within growth, there are ways you can use quality metrics to try to separate out the good growth from the bad growth. So that's the good news. The bad news is that even the best high-quality growth stocks underperform the worst value stocks on average over the long haul. So if you're just caring about long-term expected risk-adjusted performance, high-quality growth stocks prior, in a horse rate are not going to beat even low-quality value stocks. However, if there is a need, again, for job security or you need to kind of smooth that path out, and if you have to choose between just value and growth or some blend, you'd certainly want to hold kind of high-quality value, high conviction, and then maybe couple that with high-quality growth. But if you wanted to take that one step further, really what you want to do is couple value, again, with momentum, where you could maybe focus on even high-quality momentum stocks, where, again, that differentiation is momentum stocks are stocks that have had good relative performance to other securities over, say, the past year, whereas growth stocks are typically defined as just simply being expensive based on some valuation metric. But that momentum and growth, as I mentioned previously, they sound the same, but they actually are different. And a lot of people in the marketplace confuse that. So another question we have here is, what is the range of cash as a percentage of your portfolio do you keep? So that's a great question. Our opinion is that when you're developing a product for the marketplace, you want it to be as transparent and clean as possible So what we do in our portfolios is we run straight up 100% allocated in a dedicated long-only kind of what we consider best-of-breed active value exposure. And then how you want to deal with the market timing component, i.e., the percentage of cash or whether you want to hedge beta out or what have you, is kind of a different conversation. So some people, like a lot of our clients are large family offices that take our exposure and then financially engineer it based on their own opinions about how to time and whether there's value or not. We've chosen to not do that directly in our product because we don't want people to have to say, okay, I got the value process, check. Now, if you also have this cash percentage element, now I got to ascertain and understand what your market timing ability is. And now we're talking about kind of two skills at the same time. And again, we don't want to do that to confuse the market. We say, listen, long only, 100% allocated, best of breed, active value in our opinion. If you don't like beta risk or you think there's no value out there, then clearly you probably don't want to allocate a lot to that sort of, security, and maybe you put some of your money in cash and some of it outside of cash. But what we don't want to become is someone like Seth Klarman or any of these value investors who their job is really to be picking stocks, not charging you fees for holding onto your cash, because that's kind of a second skill set that we as an allocator can figure out on our own. We don't want to pay you to hold 50% of your portfolio in cash and continually charge us 2 and 20 fees on it. We'd rather you just allocate the money that you have to your strategy, and then we can choose how much total capital we give to you versus how much total capital we don't give to you, because we would rather save the management fees on that cash component because, cash shouldn't be charged fees. Anyways, that's another long discussion we can talk about sometime again. So question here, how do you overlay momentum with a value strategy? So again, a great question, and we are biased from our perch as both an asset manager, but also from someone who has to assess other asset managers and figure out, whether they're good or not. I like to look at pure exposure. So a lot of people, AQR is probably the most famous. They like to kind of blend value and momentum, and that's fine. We have a lot of opinions of why that may not be the best way to go. Our preference is build pure play, highly active, value-focused strategies, build pure play, highly focused, momentum-only type strategies, and then leave it up to the allocator to decide what percentage they want to allocate to momentum or value, but at least they know they're getting specific momentum exposure or specific value exposure, where when you start mixing and mingle the two kind of techniques and concepts, now, after you have your performance, for me as an allocator, I've got to do some financial engineering tricks to figure out, okay, was this actually driven by the value component or the momentum component or some element in between? So, it's not to say that integrating value and momentum in a unified system is a bad idea. We just have a personal preference against that because it's difficult for allocators to ascertain what the heck you're actually doing when you start blending the two things. And it's much easier if you just see a pure exposure, and now it's kind of easy to say up or out, that worked or that didn't. Hopefully that answered your question a little bit. So next question is, I got a lot of questions here. If you were a private investor, would you rather have concentrated value portfolio in micro, small caps or mid, big, large cap stocks? So that's a good question. One of the things that we've done a lot of research on is trying to ascertain whether there's a true size anomaly. And clearly when you look at the data at the outset, and we run more back tests than probably you could ever imagine, small size strategies seem to have an edge, at least historically. However, there's a huge issue there, and you got to handicap, that quote-unquote edge against the true liquidity cost associated with being invested in micro and small cap securities. Now, having done this in a former lifetime, I used to be a, Ben Graham cigar butt hunter, holding like $1 million companies that were in liquidation and all these crazy things. It's really exciting, and on paper, it looks like you can make great returns, but the problem is going in and out of those transactions, when you look at the true, bid-ask, impact costs, and all these other things, it can be upwards of, 5–10% every time you're going in and out. So if historically, let's say you see a 3, 4, 5% edge for small versus large, when you start really dialing in on the liquidity costs, you got to start questioning that. That's one element. Now, an actually more important element is tax management. So even if there is an edge in, say, for example, micro or small cap securities, but you need to invest in those portfolios via a managed account or your own portfolio or what have you, and you have a limited ability to build basically tax deferrals, and you're going to have some churning and have realized taxable gains, whereas we may have technologies in the marketplace or special designs or structures. Example might be like, an ETF vehicle, whereas even though there may be, you lose out on the edge to the small caps, and let's just assume that's true, because you're in like the bigger, mid, large cap securities, if that vehicle can help the investor defer the taxes, and now on an after-tax basis, that edge is much greater than, say, the purported edge for, like, being invested in those small cap securities, all of a sudden the calculus kind of moves back in favor of it's better to be a tax-efficient, mid-big investor than it is to be a kind of alpha-efficient but tax-inefficient investor in small cap securities. So anyways, kind of a lot to chew on there, but small caps, again, interesting, but just you got to consider the true liquidity costs, and you also got to consider the tax consequences of how do you tax manage those exposures in an effective way. So another question, unfortunately related to an ETF product, which I don't want to even mention because I'll have FINRA crawling through our front door here. So I'm sorry, but I have to pass on that one. Happy to answer that via private channels for you. Again, just compliance gremlins are everywhere around here, so we got to be careful. Another question is, what are some current examples of these much reviled stocks you mentioned that filter to the top of the portfolio? Great question, and actually there's a perfect example right now, and it's oil securities. So right now, oil, which magically everyone says they could predict that oil is going to go from $100 to $50, the past few months, when if you look at all the reports 6 months ago, 7 months ago, oil is supposed to be 150. So, we always got to take with a grain of salt what market participants are out there saying about the future. And right now, because oil did get crushed, and because it's really, really scary when you kind of look at supply-demand economics associated with, oil companies, oil servicers, and, the chaos in the Middle East. I don't know if many people follow, but, the king died in Saudi Arabia, what have you. Oil securities that we think are a great opportunity right now if you're a long-term buy and hold value type investor, because on average across the universe they tend to be the cheapest, highest quality, at least historically, firms that are out there and available for purchase. Now they have a lot of hair on them, but that is just the history of value investing. Again, it's simple in the sense that I've kind of outlined the behavioral finance framework for how and why it works. But again, it's not easy because right now you have to go buy a bunch of value stocks. Or if you're investing internationally, you got to go buy a bunch of Japanese equities. Who in their right mind would want to own Japanese equities right now, right? They got demographic problems, no economy, they're over-indebted, et cetera, et cetera, et cetera. But again, that is the story and the history of value investing. And that's just how it works. It's simple, but it's not easy. So moving on, do you apply any special market timing or is it rebounds annually irrespective of economic conditions? So again, I'm going to talk in vague terms and not refer to any specific product, but in general, for all our strategies, again, we offer transparent, long-only, 100% exposures embedded in those vehicles. If people want financial engineering in the form of market timing elements or overlays or long-short versions of it, you know, we do that as well, but in the context of managed accounts, or we'll just tell someone, hey, here's how you would deploy that. But in the core products, again, for transparency's sake, and so a client doesn't have to like figure out, okay, I think these guys have, you know, stock selection skills, but now I've also got to go do due diligence on their timing skills. You know, we just don't want to confuse the message and make people have to think about too many things at once. So one last question here I see. So it says value and momentum are negatively correlated with each other, which may reduce downside volatility. Does it make a difference if you have blended value and momentum portfolio versus pure value and momentum separately? So again, this is debatable, but our opinion is that you gain much more in the form of both the alpha component and the diversification benefits when you build out pure play value, you build out pure play momentum, and then you think about combinations of those two exposures as opposed to blending the two elements into one unified portfolio. And why might that be the case? Well, if we're looking at just value standalone, really simply, you know, you're just going to buy a bunch of cheap stocks, period. If you look at momentum simply, you're going to buy a bunch of securities that have had very good performance relative to the rest of the universe over the past 12 months. Those two universes of securities tend to be very, very different, and their characteristics are different, and that's why those pure play exposures serve as really good kind of, you know, uncorrelated elements in a broader portfolio. Whereas now if we look at, say, okay, let's do value and momentum, but we look at those kind of in conjunction with each other. Well, now we're going to be in this weird world where we kind of got some cheap stocks, but if it's a cheap stock, but it also has good momentum, we may own that stock as opposed to a stock that's just purely the cheapest out there. And the problem with that is now if you allow the value universe to kind of expand a little bit, you know, let's say you had a stock that is at PE of 5, you have another stock with a PE of 6. And you say, well, you know, the PE of 6 stocks has more momentum, so I'm going to hold the PE of 6 stock as opposed to the PE of 5 stock. You know, and because they're so similar in valuation, whatever, 6 of one, half a dozen of the other. However, what happens if you say, well, I got a stock with PE of 5 and another stock with a PE of 10. And because I've broadened my definition of what I mean by value, I say, you know, PE 5, PE 10, they're both basically equivalent on value, even though one is obviously twice as expensive as the other. But this PE 10 security has higher momentum. So now we might say, well, I'm going to invest on that, even though they've got the same quote-unquote value, because they're in my value bucket, I'm going to buy the PE 10 stock because it has higher momentum. And so what hopefully I've explained right here is that as you start blending metrics, you start moving away from the purity of the original anomaly, which in the case of value is just buy the cheapest stuff in the market. In the case of momentum, buy the highest relative strength stuff in the market. So I think it's something to think about and contemplate where, you know, the devil's in the details basically of the integration of value momentum versus pure play value momentum. It's just something to think about. Okay, another question here. September 2014 SSRN paper says that you should never sell stocks due to trading tax costs. Buffett Munger and the Voya Mutual Fund show that this can be successful. Have you guys run any studies on this? So this question is exceptional, and we hang around a lot of people that are insanely rich, and one thing that I've identified is that insanely rich people they're decent investors, but more importantly, they're really, really smart about deferring taxes. And if you know anything about compound, compound growth, when you compound 1 plus r to the 30th power, that's going to be a hell of a lot bigger than 1 plus r times 1 minus the tax rate to the 30th power. So people like Buffett, sure, they got a great strategy. They basically buy cheap, high-quality stocks. Awesome. However, the real genius of Buffett is deferring taxes and being able to compound at high rates of return, tax deferral. And again, it's just plug it in a spreadsheet and see what happens when you defer taxes and you minimize trading costs to your long-term investment performance. So I agree with this, the general flavor of the paper, which is really saying that in the absence of an ability to minimize transaction costs and minimize tax costs, you're much better off focusing on just simple strategies like buy and hold, Vanguard S&P 500, and I agree with that wholeheartedly. However, that's based on the assumption that we are unable to minimize transaction costs, and more importantly, we are unable to minimize tax costs. Now, I'm not going to talk about it too much here because, again, for compliance, but just Google out there about tax-efficient investment vehicles, and you will identify in the current marketplace there are a lot of ways where you can buy assets that trade actively. However, the manager, if they build it in a certain framework, can basically defer the taxes on behalf of the client, which means you've kind of avoided this whole tax cost. So again, is that paper correct? Yes. However, it's based on the assumption that we are unable to, basically defer and avoid or minimize transaction costs. But that is a great question to bring up, and it just, again, emphasizes that transaction costs and taxes matter actually more than alpha does. And if you don't have a tax fee solution, your alpha solution is basically irrelevant. Another question. What do you think about using momentum as a tool to avoid potential value traps? So I think it's interesting. One of the things that we outline in our book is there's actually a lot of direct ways one can try to avoid these so-called value traps. And there's a lot of, academic research out there where academics basically come up with models, a lot of times like statistical models, where they say, hey, is there any way that we can predict who the frauds, manipulators, or, next bankrupt firm is going to be? And so we utilize a lot of those, sort of technologies to basically try to screen out at the outset in our universe any firms that, are basically frauds, which would be, the definition of a value trap, where there's a reason this security is really cheap because it has a good chance of going bankrupt, and now the reason we're getting paid to own value is not because it's mispriced, but because it's way riskier. So momentum is kind of a proxy way to do that, but I think a better way to do that is to just go directly to the source and try to systematically identify through, different technologies out there, frauds, manipulators, and bankruptcies. So another question is, and this one we actually done a lot of research, but it says, what is your view on trailing or just general stop-loss strategies in value investing? So great question. And the reason it's a great question is because this is something that confuses a lot of people in the marketplace. So stop-loss strategies applied in pretty much all other aspects of the marketplace are interesting, especially on momentum type strategies where you're kind of a trend follower, you're kind of basically flowing with herd behavior and what have you. Stop loss strategies, without a doubt, and this is not just me, but this is like published research on there, help improve risk adjusted performance. Now, interestingly enough, in value investing, that doesn't work. And so a natural question is, well, why the hell does that work in momentum but not in value? Well, it turns out that momentum is a high-frequency anomaly. So if you don't churn momentum portfolios once a month, you're wasting your time, right? Like, so there's a lot of new ETF products out there. They're called momentum, but then when you look at their rebalancing frequency, it's like 6 months, 9 months, a year, and I'm like, that's stupid because you're basically not going to beat the S&P 500, and they don't want to do the monthly frequency because they're trying to make sure those strategies have huge capacity. But main point is momentum is high frequency anomaly. There's a lot of trading action. Those sort of strategies, stop loss, help a lot. Value anomaly is not a high frequency anomaly in the sense that whether you rebalance the thing monthly, quarterly, annually, every 3 years or every 5 years, there's still some quote-unquote edge, right? It obviously comes down over time, like more frequency is better, but unlike momentum, you can still rebalance less frequently and still have edge. And why is that? Well, when you think back to how value investing works, value investing itself is a long tail phenomenon. It's not like expectations change overnight, right? Value, as they say, is its own catalyst, but you might be stuck in a value stock for 2 years before people realize that, hey, oil, for example, is not dying, and we're going to still need it or what have you. So stop loss strategies actually kill value investing because value investing strategies tend to have a lot of short-term volatility. Because people are afraid, like they don't want them, and everyone's like, oh God, like why would you want to own these things? So what happens is they get a lot of whipsaws in the short term, where stop loss strategies, they're going to whipsaw you out of that. So you got a stock, like let's say you buy some oil stocks right now. We know that on average over the long haul, that's probably going to be a good expected bet. Is it a guarantee? No, but good expected bet. We also know that in the short run, oil is volatile as hell, and those stocks can get cut in half, and that's part of the game. Now, if you stop loss strategy, something like that, what's going to happen? Well, what's going to happen is you're going to end up getting whipsawed out of this violent short-term volatility that just happens to be associated with these value stocks. And unfortunately, any sort of kind of risk management benefits you might get with the stop loss in the context of value investing is overwhelmed by the fact that you got all this whipsawing with transaction costs, taxes, and what have you. So we basically don't recommend it in the context of value investing. It's better if you're worried about, beta, use some like market timing overlay that utilizes like trend following or something like that, and then focus kind of stop loss efforts in the context of like momentum investing or more higher frequency anomalies. What would be my general advice, just based on what kind of the evidence suggests out there. All right, so it looks like we have no more questions. You guys asked a lot of questions, which is good. So if that's it, I guess, Cynthia, I'll hand it over to you. And
I'm right here, Wes, and thank you very much. And we all really appreciate the time that you spent answering those questions. Now, before you do leave today, I have one piece of business we've got to cover, and you'll find that I'm going to open it up on your screen right there. It's a poll. IB's management does require that we run a poll in each of these events to elicit your feedback and make sure that we're giving you or presenting information that is relevant to your trading needs. So with 3 short questions, please take a quick moment and fill those out. Now, 2 are multiple choice, but you'll find there's an input field in number 2. Now, that is a great place to put any comments or suggestions you might have on other topics you'd like to see covered in these webinars. Oh, the poll did end, everyone. Thank you so much for participating in that. That really is very helpful information. Now, you can all exit today's session. By the way, that is going to conclude our presentation today. And notice in the upper left-hand corner, you can exit using the X that's included here. But I do want to point out, as you do exit the session, you'll find a new browser window is going to open up with today's slides on it. It's available there for download or printing. Simply click that PDF button and you can access those notes. By the way, we have been recording today's event, and you can all listen to that playback. We'll be emailing that out to you just as soon as I get it compiled and uploaded to our servers. So if you want to come back and review the concepts that Wes went through today, simply watch your email later on this afternoon. Well, with that, once again, I want to thank Dr. Wes Gray with Drexel University and Alpha Architect for today's presentation. And I also want to thank all of you for your participation with us here this afternoon. Have a great day, everyone, and please do trade smart. Thanks all. Have a good one.